Welcome to Talk Tickers. We give you the quick analysis of the most important earnings calls, really tailored for you, the experienced investor. Today, we're doing a deep dive into Silicon Motion. They're a leader, maybe the leader, in semiconductor storage controllers. We're looking at their Q3 2025 results and their forward guidance. The call happened free-market back on October 31st.
Yeah, and this call really stood out. It wasn't just, a simple beat. It felt more like a full operational story. Management's execution really seemed to back up their whole bullish strategy. The big takeaway right off the bat is that they seem to be successfully riding these structural shifts, this secular uptick we're seeing in high-performance storage and increasingly enterprise.
Maybe let's unpack that, starting with the results snapshot, because, the numbers were pretty hard to ignore. Management delivered way ahead of what people expected. They cited strong product momentum, said they were running ahead of their internal plans. Non-GAAP EPS landed at $1 per ADS. That's American Depositary Share for anyone tracking internationally, which really blew past the consensus. That was around 81 cents, right?
Yeah, 81 cents. So a very solid beat on the bottom line. And then on the top line, revenue hit $242 million. That sailed past the consensus estimate of about $225 million. Now, just to give that some context, that's up 14% from last year, but maybe more telling is the sequential jump. That's a powerful 22% spike quarter over quarter. They're definitely accelerating. Looks like they're really pulling out of that earlier memory downturn we saw.
And acceleration usually means better leverage, right? Their non-GAAP gross margin expanded to 48.7%. That hit the very top end of their own guidance range. Operating margin reached 15.8%.
And we also got a really clear signal about their financial health and their commitment to shareholders. They kicked off a new capital return program, announced a $2 per ADS annual dividend. First payment's actually due later this month, November 26th. With over $272 million in cash and short-term investments on the books, this dividend, it almost acts like a psychological floor for the stock. It really underscores management's confidence in generating steady free cash flow.
Right. And the market reaction kind of showed that investors were looking for this confirmation. We saw, a fairly modest gain on the day, intraday, but the volume was telling. It was 2.4 times the three-month average. That high volume suggests that, maybe strong results were somewhat baked in, but seeing the strong execution confirmed, plus that new dividend, that seemed to trigger some high conviction buying. Okay, let's jump into the strategic deep dive then, starting with the sort of nuts and bolts of their financial discipline. Cash flow from operations was solid, $26.9 million, easily covered their CapEx, which is $15.6 million. So they're generating positive free cash flow, even while they're investing pretty heavily in R&D and future growth.
Well, what's really interesting is how they're choosing to use some of that cash. We need to talk about inventory. They reported a strategic increase. Inventory jumped, get this, 62% sequentially, up to $79.5 million.
Whoa, okay, 62% inventory jump. That sounds, for experienced investors listening, that sounds like a potential red flag, right? A huge risk if the economy suddenly takes a downturn. Why are they comfortable taking on that much inventory risk right now?
Well, they presented it as smart, proactive risk management. Especially given how aggressive their forward guidance is, management was explicit. They said this build is to support their growing backlog and just to get ready for what they expect to be a really strong Q4. And crucially, it helps mitigate potential supply chain headaches. Specifically, they mentioned shortages of BT substrates.
BT substrates. And just for listeners who might not be deep in the weeds on this, a BT substrate isn't just generic packaging. It's a super specialized component used in advanced chip packaging, particularly for high-performance stuff. And it's a known bottleneck across the whole semiconductor supply chain right now. So they're basically stockpiling these essential, hard-to-get parts to make sure they don't miss out on revenue because they can't get components.
Exactly. And having that buffer, that strategic inventory, allows them to put out some really aggressive forward targets. Their guidance for Q4 2025 is robust. Revenue expected between $254 million and $266 million. That's another, 5 to 10% sequential increase on top of Q3's big jump.
But the margin story is maybe even more impressive. Operating margin guidance takes a big leap. They guided it to expand significantly, reaching between 19% and 20%. That's getting close to their historical peak profitability levels. And they're saying it's driven by higher revenue volume and a much better product mix, higher margin stuff.
Right. And just to tie it all together, management sounded extremely confident. They explicitly stated they are on track to exceed an annual revenue run rate of $1 billion this quarter. Q4. That's a nice, clean benchmark, something you can really measure their execution against going forward.
Yeah, that $1 billion run rate target. It's clearly fueled by success in their key strategic growth areas.
Yeah.
Let's start with client SSDs. The momentum behind their PCIe Gen5 controller seems immense. That 8-channel performance controller they launched late last year drove 45% sequential revenue growth just in Q3. And it already makes up over 15% of their total client revenue.
And importantly, that controller has locked in major design wins. They said across 4 of the 6 big NAND flash makers, the next shoe to drop, the next big driver, is their new 4-channel version. That one's aimed right at the mass PC market. It's just starting initial shipments this quarter, Q4.
Okay, I have to push back a bit here, just playing devil's advocate. Management has this goal, right? Pushing their overall client market share from around 30% today up to 40% in the next few years. 40% share in client SSD controllers. That sounds incredibly ambitious. I mean, what makes them think they can realistically take that much share from the big incumbents?
Well, the argument is it ties back to those structural industry shifts we mentioned. Their existing relationships with NAND partners are strong, sure, but maybe more importantly, look at their other growth driver, eMMC and UFS controllers. Revenue there was up over 20% sequentially, and get this, 35% to 40% year over year. This is almost a textbook case of opportunity created by necessity elsewhere in the market.
Necessity for the big integrated memory players, you mean?
Precisely. The huge NAND manufacturers themselves, they're increasingly outsourcing these controller needs. Why? Because they're shifting their internal focus, their engineering talent, their capital spending. It's all going towards DRAM, HBM, and especially AI-related flash for training models. Those are higher priority, higher margin for them. So this structural shift creates a vacuum, a big opportunity for merchant controller providers like Silicon Motion to step in and grab share in these high-volume sort of bread and butter markets like automotive, industrial, IoT.
Right, so executing well in those high-volume markets provides the foundation, the cash flow, to fund their pivot into the highest margin opportunity, enterprise storage, which is centered around their Mont Titan family of controllers. And this is where the AI story really crystallizes. We've all heard about AI training needing pricey HBM and high-end TLC flash. But the next wave is AI inference, the actual deployment of these models. And inference is driving huge demand for high performance, but also high capacity SSDs based on QLC flash.
Exactly. QLC, quad-level cell flash. It offers much higher storage density, usually at a lower cost per bit compared to TLC. That makes it ideal for the massive data sets needed for what they call warm storage and for those inference workloads. So Mont Titan is strategically targeting both compute storage, which still uses TLC, and this potentially much larger long-term opportunity in high-capacity warm storage using QLC.
Management kept the goal pretty measured, though, which I think is smart. They're saying Mont Titan should contribute maybe 5% to 10% of total revenue by late 2026 or into 2027. But we already have a proof point. They started volume shipments of a boot drive solution to a leading AI GPU maker this quarter. And they mentioned qualifications for the next-gen products with that same customer are already underway. That's a huge foot in the door, the most critical, fastest-growing part of the market.
Yep. And while, the AI and enterprise story gets all the buzz, we shouldn't overlook their diversification into automotive. They're racking up Tier 1 design wins there, too. Mentioned a major Japanese manufacturer and a large South Korean customer specifically. The target there is for automotive to be at least 10% of revenue by that same 2026-2027 timeframe. It looks like a very deliberate strategy to diversify the revenue mix, get less dependent on just the pure client PC market.
Okay, so let's pull back again. Look at the broader investor context. What are the macro wins, tailwinds, and headwinds? Well, management gave a pretty sobering outlook on NAND supply. They expect the severe NAND supply shortage to stick around, potentially all the way through 2026, driven by, relentless AI demand meeting years of reduced CapEx spending by the flash makers themselves.
Okay. Now, you might initially think, a shortage, that's bad for a component supplier. But actually, in this specific situation, it seems to favor Silicon Motion structurally. Why? Well, the shortage pushes OEMs faster towards adopting QLC technologies, simply for cost and density reasons. And Silicon Motion claims an advantage in complex QLC controllers. Plus, it makes the big NAND flash makers more willing to partner and outsource controller development because their own internal engineering teams are just stretched incredibly thin, focusing on producing the highest margin AI flash itself.
Right. Management had some strong quotes on the call. Things like being never in a better position to expand market share. Right. And that they're just getting started in enterprise storage, their aggressive inventory build, the strong Q4 guidance. It all signals they really believe they can seize this moment.
And finally, just a quick but necessary legal update. That long-running arbitration case. The hearing itself was held earlier in October. Oral closing arguments are now scheduled for March 2026, and then a final decision is expected sometime after that. So at least we have a clearer timeline now for when that might finally get resolved.
Looking ahead then, the future catalysts seem pretty clear, and they're measurable. Obviously, Q4 results need to see if they hit that high bar they just set. Then, continued news flow on enterprise controller design wins, confirming that MonTitan ramp is real, and probably updates on their PCIe Gen5 roadmaps later on, which would solidify their leadership in client performance moving forward. All right, now for our segment. This is not financial advice. Let's try and synthesize this. We've got a clean beat, really powerful guidance, and they just launched this new capital return program, the dividend. So the company's confirming strong cash generation right as they hit that symbolic $1 billion annualized run rate target. But, and this seems key, the MonTitan enterprise story. It feels like it's still significantly underramped, maybe underappreciated by the broader market.
Yeah, exactly. So the plausible trade idea here leans into that. It's a longer-term bullish strategy, leveraging conviction that this enterprise ramp is, well, maybe inevitable, or at least highly probable, while using that new dividend floor as a way to potentially mitigate some of the volatility along the way.
Okay, so given the margin expansion implied by that 19-20% operating margin guidance for Q4, one idea, again, not financial advice, could be initiating a leveraged long position, maybe using deep-in-the-money call options, specifically looking out to early 2027 expirations. This would be a direct, fairly long-dated bet on that MonTitan revenue target, the 5% to 10% contribution being hit, or maybe even beaten ahead of schedule, driven purely by that accelerating QLC and AI inference demand we talked about.
Right. The structure of that kind of trade aims to capture both the potential margin expansion and that shift in the sales mix towards higher value enterprise products. And like you said, that new $2 annual dividend acts as a bit of a psychological cushion, a hedge against unexpected short-term market bumps. It could allow the trade more breathing room, more time to patiently ride these big structural AI storage tailwinds over the next, say, 18 to 24 months.
Absolutely. So to recap, Silicon Motion put up a fantastic quarter, gave really powerful Q4 guidance, and they laid out a strategic pivot that seems to position them perfectly to benefit from these huge AI-driven structural changes that are just transforming the entire NAND market.
And remember, everyone, this content is just for informational purposes, definitely not financial advice. But maybe we can leave you with this final provocative thought to chew on. Given that the global NAND shortage is expected to persist, likely driving costs higher through 2026, how much faster will the big OEMs, the hyperscalers, need to shift their massive data center and warm storage deployments over to QLC? And if that shift accelerates even more than expected, could that 5% to 10% enterprise revenue target for late 2026 or 2027 actually turn out to be, well, far too conservative?
Something for you to mull over. Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive.